Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm happy to have with me once again John Rubino. Just jot down the website for John Rubino. It's dollarcollapse.com. Dollarcollapse.com. Go there and partake of a lot of the good things that John puts up there. A lot of articles, things he writes, other people write, and you can't go wrong by doing that. So thanks for joining me again, John.
Oh, sure, Jay. Good to talk to you. Hey, before we start, I think your listeners should know how well the stocks that you're picking with your newsletter are doing.
I know they're doing well.
They really are rocketing. You're making people a lot of money. I've been trying to buy Golden Predator for the last couple of months, and my first bid was like 40 cents a share. It is now over $1 a share, so it's more than double just in the few months that I've been trying to buy the thing. So congratulations. You're doing all right.
Well, thank you for that. And Golden Predator is a sponsor to this show. I picked the sponsors for this show, the companies that, for the most part, the companies that I really like, companies that I've recommended. And I think Golden Predator it's a remarkable story with lots of heavy hitter, big money people in that story, in that stock. And it is really extremely high grade, near surface, incredibly high grade stuff. So I think we're going to hear a lot more good news from them and several of the other companies that I have on my list as well. So thanks for that, John. I appreciate that. It's always better to have someone else toot your horn than to try to toot it yourself, So thank you for that. Well, anyway, John, our question for the day is, who's going to win the big fisticuff between President Trump and Janet Yellen? And I'm assuming there's going to be a fight. Maybe you don't think so, but I'm assuming there's going to be a brawl. Trump is going to need a weaker dollar, I should think. He's going to need low interest rates. And if you get aggressive in that regard and pump huge amounts of money in, the dollar might be weak vis-a-vis some of the other currencies. The Fed doesn't want that, it seems. And besides, the Fed seems to be saying, hey, the economy is really starting to respond to our wonderful stimulus, monetary stimulus, and now we're going to have to put on the brakes because otherwise we're going to have a runaway economy and runaway inflation. And I don't really buy that one, but the whole notion is that if Mr. Trump wants to bring jobs, wealth-creating jobs back to America, the last thing he needs is an extremely strong dollar. So what are your thoughts on this, John? Or first of all, let me ask you, do you think that the economy is really as strong as the Fed pretends it is or saying it is, and therefore higher rates are required?
Well, the headline numbers look pretty good, but the headline numbers are untrustworthy, as your listeners know. The unemployment rate and inflation and stuff like that. These aren't numbers that they can be compared to previous numbers throughout American history because we're calculating them differently or they have ceased to mean the same thing that they used to mean. Mm-hmm. So it's hard to tell how well the economy is doing right now. But I will say that there are three basic kinds of stimulus. You can have fiscal stimulus where the government borrows and spends a ton of money. Monetary stimulus where the central bank creates a lot of new currency and tosses it out there or forces interest rates down or does some other kind of monetary thing to stimulate the economy, or a plunging currency. If you devalue your currency, that's very stimulative. So they've got these three things out there that they have to figure out how to reconcile because they're in some ways contradictory. You can have monetary stimulus and fiscal stimulus, which would be the Fed cooperating with the central government to really stimulate the economy. Trump borrowing a ton of money and spending it, Yellen cutting interest rates and printing lots of new dollars. That would be incredibly stimulative. And then the dollar would be the wild card in that, because if it plunges as well, which you might expect with that kind of stimulus going on, that's really inflationary, which in the long run is actually not stimulative because it pushes interest rates back up no matter what the Fed wants to do. And so that's like a big tax increase on everybody. So there are a lot of moving parts to this story. But it's interesting that for the past few years, Keynesian economists have been saying that, well, monetary policy had really run its course. We've pushed interest rates down to near zero, and we bought up most of the bonds that were available to buy within most major central bank territories. And so now it's time for fiscal stimulus. So it's interesting that the Republicans ended up putting somebody in charge who is gung-ho for fiscal stimulus. So it's interesting that we might see a changing of the guard in that way, that interest rates stay stable or go up a little bit, while the government borrows a lot of money and spends it, and we get our stimulus that way. So there's lots of ways to put this together. And I don't think it's necessarily a battle between Yellen and Trump, although their conversation has got to be awkward. You know, when those two sit down to talk, they have such different personalities that it's hard to imagine them, being drinking buddies or anything like that. They just don't seem like they would get along well or get along comfortably. But
you go ahead.
Oh, okay. Well, I was just going to say that one way or another, we get stimulus going forward. I think that's pretty much a given around the world. You know, if we weren't actively stimulating the major economies, they would slip back into a recession, which could easily metastasize into a depression. In the U.S., for instance, very quietly, the Obama administration borrowed over $1 trillion in its last year in office.
Yeah.
That's a huge stimulus. That's a monster fiscal stimulus already.
Right.
But they did it without any kind of an announcement, I think in part because they wanted to win this election coming up. And governments tend to do that. They tend to stimulate the economy behind the scenes in order to get their people elected. It didn't work, but that was probably why they did it. And that's also probably why the numbers look pretty good right now. You know, the top line numbers in a lot of different sectors in the U.S. are coming in stronger than people would have expected at the beginning of 2016. And a big part of that is because we borrowed a bunch of money and spent it. You know, there's nothing really mystical, magical, or surprising about how borrowed money increases economic activity, right? And the problem is that it only does so in the short run, and in the long run, it slows things down because you have to pay interest on that debt, and then you've got to pay the principal back at some point. So we're basically borrowing from future growth when we borrow lots of money in the present. And we've been doing that forever, you know, and apparently we're accelerating the process now. Obama's last year was huge for borrowing. Trump's first year is probably going to be pretty big too. So I think stimulus and the destabilizing aspects thereof are pretty much baked into this cake. You know, we're going to have increasing instability going forward just because all of this leverage was already unsustainable. If we're going to ladle more leverage on top of what is already, globally speaking, debt of 350% of GDP or 1,100% of GDP, depending on how you calculate debt, that's already pretty much a guarantee of a gigantic financial crisis out there somewhere in the intermediate future. And if we're going to just put the pedal to the metal and keep on borrowing, then it's just going to be bigger when it hits.
Yeah, well, the three different ways of stimulus, for sure. But, you know, I couldn't help but notice that Peter Navarro, who I guess is Trump's trade advisor, suggesting that the euro was way too weak and needs to be stronger. And I think Trump made some remarks yesterday suggesting that he sees both not only China but also Japan as currency manipulators. Those are sort of remarks that seem to trigger a downward trend for the dollar, fairly significant one today. And there's I think 0.8 or so on the index, and gold, of course, has had a day. It's risen as much as $20 at one point, I think, today. Mm-hmm. What do you attribute today's move to, John?
Well, I don't know about today's move, although it seems to be related to the uncertainties around some of Trump's policies. You know, the banning of people from 7 countries just out of the blue, and then he fires the acting attorney general who refuses to enforce that rule. You know, that's the kind of thing that you would expect to spook markets, right? And to send money into safe havens. So that stocks went down and gold went up while all that was going on isn't surprising. You know, that's a pretty reasonable explanation for what's happening. But as for the dollar, to understand where we are now, you got to go back a few years to when Europe was falling apart. 3 or 4 years ago, the Greek crisis was bubbling up, and it really looked like Europe, or at least the European project, was on the verge of imploding. And the only thing that they could really do to keep it together was to devalue the currency, because that takes some of the pressure off of Italy and Spain and Portugal and Greece. And so they did that. And they probably did it with the complicity of the U.S. In other words, we took one for the team in order to keep the global financial system from imploding, beginning with Europe and then metastasizing around the world. But it came at a cost. The U.S. dollar is extremely strong. It's really the only, other than the Swiss franc, the only really, really strong currency out there. And that hurts our manufacturing and exporting companies, who are reporting generally pretty bad numbers. Our earnings seasons are real adventures lately, because company after company will come out with substandard numbers and they'll blame it on the strong dollar. Now, Trump sees that. As a business guy, Trump doesn't like that, of course. He wants the financial conditions to be optimal for whatever kind of business he's looking at or thinking about. And a strong dollar is suboptimal for most kinds of major U.S. industries. So he's expressing something that most corporate CEOs probably express in the privacy of their own boardrooms, that the dollar's too strong and we need to weaken it because these guys are getting a free ride out there, Europe and Japan and China. And so presidents in the past have been hesitant to say that because they don't want to crash the dollar. That was something they wanted to avoid if they could. And they wanted to allow other countries to weaken their own currencies because they were seen, those other countries were seen as more serious risks than the U.S. was. Now, Trump isn't playing by those rules. And he is apparently willing to take the risk that the dollar drops by 20 or 30% in the next couple of years. That would be great for our exporting companies. It would be inflationary here in the U.S., so it would be great for gold and silver, but it would be really, really scary for China and Japan and Europe, because that means their currencies will be going up in value, because currencies are just valued against each other, not against anything real other than gold. And so for the dollar to go down means the euro and the yen and the yuan have to go up. And these guys are in no condition to manage a 30% increase in the value of their currency. That's potentially an existential threat to the Eurozone. And maybe China and Japan. They're both teetering on the edge financially. We could spend entire shows talking about the financial mistakes those guys have made. So they're not in any kind of shape to sustain an adverse change in the terms of trade. And that seems to be something that Trump is trying to engineer. If he spends a lot of money here and talks down the dollar and convinces the Fed not to raise interest rates anytime soon, then presumably we'll get a stable to much weaker dollar somewhere in there. And it'll be at the expense of our trading partners. So this is an adventure that we're entering into now, and I'm not sure it's well understood.
Yeah. It potentially trade wars and, beggar thy neighbor sort of thing, which has been going on. But as you say, the U.S. has been willing and able to, up until now, at least politically, to take it. But now, in rides Donald Trump on his white horse to protect the jobs of Americans. And, it's going to be very, very interesting to watch and very important, I think, to the markets that we watch as well. One analyst that I saw, Trump is talking a lot about fiscal stimulus and all that, although I think when you look at $1 trillion over 10 years, it's relative chump change compared to what China spends on infrastructure and so forth, or what they have spent at least. Nonetheless, one analyst is suggesting that the more Trump pushes on the fiscal accelerator, the harder the Fed is going to hit the brake and restrict money supply. But on the other hand, in reading an article that you wrote, I think earlier, it was on January 24th, titled 2017's Real Milestone, or Why Interest Rates Can Never Go Back to Normal. Talk to us a little bit about the dynamics, why interest rates can never go back up to normal. Normal, I think, is something like, as you pointed out, the average government rate paid back in 2000 was 6.6%. Now, who can imagine a 6.6% interest rate now for the government? But in any event, what are the dynamics in play here that might keep the Fed from wanting to battle Trump? I mean, aside from an economy that might just collapse.
Yeah, well, The amount of debt that we've taken on at the federal level is really shocking, and people don't seem to be paying much attention to it because it's become the new normal. But under George W. Bush, his 8 years in office, the federal government doubled the national debt, which means that he borrowed as much in his 8 years as all previous presidents combined, from George Washington all the way up through Bill Clinton.
Right.
Which seems like a record that won't be equaled for a while, right? But Obama did it. Obama subsequently doubled the national debt in his 8 years. So we went from $5 trillion to $10 trillion under Bush, then $10 trillion to $20 trillion under Obama. Now, we've done that with falling interest rates, so our interest costs have not gone up. But if we try to normalize interest rates, which is one of the goals of the Fed, because they want interest rates to be high enough so that they got some room to cut in the next recession. And they want to be able to say, well, look, we're back to normal. What we did worked. And you can tell that because all the metrics are back where they used to be historically. Well, if we did that, that would basically triple the federal government's interest cost, which would bring it to about $1.3 trillion a year, which is pretty close to 30% of the entire federal budget, just going to interest. And that would require either massive tax increases or massive spending cuts to fund, or some kind of monetary stimulus, a huge amount of borrowing financed with a lot of new currency creation, which would put us right back where we were to begin with. And so if we tried something like that, if we tried to equalize interest rates, it would effectively bankrupt the government. And that's just the U.S. We're in much better shape than, for instance, Japan, where if the Japanese government's interest rate just goes back up to what we pay today in the U.S., up to 2% and change, their interest costs would exceed their entire federal tax revenue. So when you look at these numbers, you realize it can never happen. We can never go back there because we would be bankrupted by the transition. And so this talk of normalization, I think the best they're going to get is, another percentage point or two up from here, if even that, before the next recession hits. And then all bets are off. We're going to go into a recession next time around. And by the way, a recession is due. The average length of a recovery is around 6 years. And we're in the 9th year with this recovery. So if history is any kind of a guide, we've got another recession coming pretty soon just because of the general shape of the business cycle, leaving aside all the other crazy stuff that might tip us into recession. And when that happens, then government borrowing spikes again from wherever it is, which means it'll go from $1 trillion a year to $2 or $3 trillion in the U.S. Interest rates will fall, and that means they'll fall from zero to negative rates in many places around the world into much more negative rates. And so what we think of as more or less normal today is going to be swept aside by some serious monetary and fiscal experimentation where the numbers are bigger than they've ever been before. And we push the envelope. We see what we can get away with, and if we can get away with it. And my guess is that we won't be able to. It seems like the next iteration of these experiments will be the last, when this just completely blows up, because the numbers will be just insane. They'll be so huge that nobody will look at them and believe that we can manage it.
John, we've had this exponential growth in debt, as you pointed out. From 5 to 10 and then 10 to 20 under Obama, and I have to ask, who's going to buy this stuff, especially if it's negatives and the negative rates, and the Fed doesn't want to hold all this debt on its own balance sheet. Who's going to buy it?
Well, it'll be other central banks buying it, almost certainly. Which means, in effect, we're just going to be financing the world's governments with newly created currency. In other words, just completely monetizing the governments of the world. And in effect, cutting out this middleman of issuing debt and giving it to banks and then buying it back from banks. That's just a charade that the governments of the world go through now to hide the fact that they're just financing themselves from newly created currency. So when that becomes obvious to the rest of the world, that's another reason why, it's another catalyst for the next crisis. But there's no way to know exactly when it happens or exactly the shape of the crisis, just that something related to this is coming, and when it hits, it's going to be just huge.
Yeah, I just can't picture it. I mean, negative rates coming, John. I mean, you're not going to get people to. You're going to force people to. They're going to steal from our accounts, or how are they going to finance this stuff? I just can't picture it.
Well, negative rates on a bank account is, in effect, you financing the federal government by giving them a little bit of your bank account each year.
By theft.
Yeah, by theft. And negative interest rates are effectively theft, as is inflation. A 3% inflation rate, let's say, which is kind of a target of theirs right now, means that 3% of your wealth in a bank account is taken away and given to the federal government to spend as they see fit. So all of these things are, in effect, secret theft. And eventually, people figure it out. It's gone on longer than a lot of people in the sound money community, including me, thought was possible. I thought 2005 or so would be the end of this whole scam. And it wasn't. We managed to do an entire new cycle with even bigger experimentation. So the next time around, there will be some new stuff. For instance, the central banks of the world will start buying equities, which Japan and Switzerland already do. They'll start buying corporate bonds, which the European Central Bank already does. And they'll push interest rates down as far as they can, and then declare some kind of war on cash, where they'll make large denomination bills inconvenient and or illegal, so that we're forced into electronic accounts where there are negative interest rates so they can harvest us. All of that stuff will happen next time around. And so it becomes a question of whether people will put up with it. Will we accept this as we accept, 0.05% on our bank accounts now? Will we accept negative 2%? Will we accept $100 bills becoming illegal? I suspect that we won't, and that we'll start black markets and start buying real assets with our paper currency, and the Austrian economics crack-up boom will finally happen.
Yeah, it's a frightening prospect, no doubt about it. The negative, I mean, all those things you're talking about are very much in the works now.
They all
there's
are,
no question about it. They're all in the works now, so they're very well prepared for it. We're seeing the Trump revolution, which is a backlash against the establishment, against the stuff that's going on. I'm not sure that most of the people that voted for Trump understand the reasons for why they're having trouble. I don't think they really understand the monetary foundation that allowed this to happen. Very few people would understand the connections you and I understand so well. If we had an honest monetary system, none of these excesses could have gotten to these levels without the system breaking down or correcting, right? Yeah.
If people understood how a monetary system was supposed to work, we couldn't have gotten this far. But, things have been so good in the West, or in the developed world in general, for such a long time that it hasn't been necessary to really think about the ins and outs of money. Money just was the environment. It's just dollars and euro and yen, that's just what is, and so most people go to their jobs, come home, have dinner, play with their kids or their friends, get up and do it again, and don't spend a lot of time obsessing over, the nature of money and the role of the central bank and the federal government vis-a-vis the money supply, stuff like that. So we're going to have to educate ourselves over time in order to make informed decisions. But, you're seeing people buy gold and silver, for instance, at an accelerating rate. That's a sign that they kind of get it.
Yeah.
And a lot of the votes that were cast for Trump were by people who aren't necessarily, obsessively expert on monetary policy, but they saw that things were going wrong. And they heard somebody say that they were, they weren't delusional, that things were really wrong and he would try to fix it. And that alone is a sign that we're turning a corner now, because people get it. People get that things aren't right. And from there, they'll think it through a bit and come to some conclusions about how it should be. And at that point, the whole, Ron Paul sound money idea will become a little more marketable in the political marketplace, and we'll have a really interesting debate about the role of the federal government versus individuals and the nature of money and stuff like that. And hopefully, sound money and individual freedom will win in the end. But it's going to be quite a battle on the way.
Yeah, it's going to be a battle, and when people are ignorant about the basics of economics, and when they're led to believe through their university economics courses that you can create money out of thin air, the Keynesian economic theories that suggest that you don't have to be, that it doesn't matter, savings doesn't matter, time preference of money doesn't matter, the realities, and that's why sometimes I think the guys, the rednecks, sometimes in practical terms understand better about the way the world really works than the PhDs from Harvard, Princeton, and Yale. But in any event, in terms of what people should do now then in order to protect themselves, it seems to me one of the things that I've done, John, on a very small scale because I'm just testing it out, is goldmoney.com. You can take your money out of the banking system, take what money you have before the government takes it all from you or starts to negative interest rates. Take your money, buy some gold, put it in a vault, and when you need to take it out to spend it, you sell the gold, put it into currencies, into U.S. dollars in my case, and load my debit card with U.S. dollars, and then go spend it as you need to. But hold your savings in gold, and the people at Gold Money have shown out, over in a short period of time, that may not work out, but longer term, even in U.S. dollars, as we know, as you and I know, I remember the days when gold was $35 an ounce. Certainly, over the longer run, the currencies are debasing, the best of them, including the dollar. Any thoughts about that? Is that one way people might look to do? Because you need liquidity at the same time, John. You can't take the gold down to the corner store and buy a quart of milk or whatever you need. You need liquidity. So to be able to take it from Gold Money, sell your gold in whatever amounts you need to, and then load your debit card, and you've got dollars again. Thoughts about that?
Yeah, I love the concept. I'm not technically proficient in how they're executing it, but the idea that you can move your gold across borders in a debit card is a huge quantum leap in the usefulness of gold, because that's one of the big problems with something like precious metals in general, is that it's heavy and bulky, and it's hard to transport from one place to another. Mm-hmm. So it's a great store of value, but it's not the most portable store of value. So if Gold Money is making it portable, that's a really big deal, and we'll see how they handle rising volumes, which they're seeing now, I guess. They're growing pretty rapidly. So if their systems can handle it, and over the next few years they're able to expand and manage all the transactions without a lot of glitches, this is going to be very big, We'll have Bitcoin and digital gold as competing currencies out there that are non-national.
All right,
they
John,
aren't subject.
We're going to have to leave it go at that. We're out of time now. Thank you so much for being with us, and we look to do it again sometime in the near future. Thanks so much, John.